What's over? Good morning. All right, good morning, everybody. Good to click that thumbs up button. We love y'all. Get ready to get started here. We have the morning. It's like we started the day off with the Nasdaq already touching the DD band. Looks like we already have kind of a semi-completed day. I'll probably trade it less aggressively today than yesterday. All right, take a look this morning. So we have some major earnings today. Tesla's this afternoon after close. I think AT&T's on the list. IBM. We have PMIs coming up. Keep in mind. It's going to be in 15 minutes, so that could give us a little bit of a pop and drop, so just be careful. How these catalyst days can be. It could be one possible red day in the sea of green. But again, you never know how people are going to respond to these things, so kind of take it easy. Other than that, nothing else. So 15 minutes. Event time. Hey, friends. Good morning. Morning, family. What's up? E-tie little bull, bearing bulls. Byron, Alexander, JX, Louis, Ali. What's up? Horizontal Plane Beavis. What's up, y'all? Okay. One heck of a trading week. Been fun. Back-to-back bullish liquidity maps, back-to-back golden setups. I mean, very nice. 1,000, you know. Like, well, will I record this? This is all, these are all recorded. All right. All right, just to start off the morning, let everybody know what we have. Just remember, below triple B, razor sharp pivots. You guys know the rules. Inside of here, Nasdaq's already touched the upper DD band. And S&P is looking like it's got some room to travel. This could be a smaller sit out there. There's about 13 points left in the S&P. I'm going to let it do its thing. Remember, when this happens, the day is usually considered over. The overnight trading has just drifted up a little higher. We'll let that PMI happen. So nothing in the first 15 minutes. I'm not taking an opening trade. I don't care what it looks like. I'd like to see what I typically think of days like this. So we get a nice little pop on the news and then it pulls back somewhere and then it ends up closing somewhere in the middle. So I'm going to trade the extremes and avoid everything and not try to get the continuance. Like essentially like, what am I going to get this move? It's going to go up. Let the event happen. Very strong resilience. Everything's popping up. So, you know, the market's open very high today. We do have limited upside, I would think, as well with this VIX thing going on here. Let me show you how this works. I think every bone in my body is just telling me kind of like do nothing until that event comes out. If that event drops, I'd like to take a long. Any upside is going to be limited. Oh, I can draw my screen now. Any upside is going to be limited by, remember, when the market goes up, VIX goes down, there's a bounce point. So somewhere in here, it's going to get really choppy. Okay. Let's take a look at the liquidity map we get today. Oh, nice. So this is a bull long up. So I'm glad that I'm waiting. So watch everybody watch this one. Watch. You have this to DD is trade 1A. Same as we had the other day. From here to here is 1B. Res greater than 0, we pivot through there. Res less than 0, we pivot through there. Y'all know the drill. So what I'd like to see is I'd like to see the news somehow get us to here. I could scalp it from there to there at minimum. I can get like a nice little 15-point scalp off a hedge pressure. Let's see how this works. So ideally, today, ideal sense, there's two different scenarios. Either A, we could get that hedge pressure dip and then run to there. Scenario 1, or get a hedge pressure dip to half gap, which is a decent scalp. I feel like I'm being greedy if we continue along this like it is, and then reassess based on res. Right, sound like a pretty good idea. What's up? Hey, what's up, Cruz? How you doing, man? Good morning. What do you guys think? All right. Beavis goes all-time high. Beavis, I'll tell you something. Don't ever, as a trader, think of it. I'll tell you my suggestion. Never be scared of all-time highs. I know that's one thing that makes, I guess, technical traders kind of like grimace a little bit. Markets have always, or the index has always rallied over time. And to be like, okay, it's close to all-time highs, maybe it could sell. That's the mentality I try not to ever have. What I try to do is I try to pretend like the previous days have never existed, and this is a brand new day, and all this is not relative to anything else. So I don't say like, okay, we're at 4,900, we were at 4,900 as all-time highs, and might crash out. There could be a psychological resistance and barrier sometimes, but I like to take every day at face value on its own merits. If that makes any sense. So basically, I ignore it. And to me, it doesn't matter how close we are to all-time highs, all-time lows, whatever. I can consider, okay, maybe psychologically markets can pivot there, but there's no what's what I'm looking for? Strategy to consider something like that. So I consider it to have just a random effect, and therefore I just don't consider it. I use whatever's in front of my face regardless. The same tools and same strats. Yeah. Like I wouldn't be afraid of a rally that's at all-time highs and all-time highs and all-time highs and say, okay, well, it's breaking highs. It's probably going to sell. This seems to me to have no strategic merits to it. So I always have ignored it just because it's impossible to know that, right? It goes and moves overnight. Well, remember, those dynamics are really strong. Let me show you how the dynamic bot told you. And remember yesterday's Yesterday's Zoom call we had, and that's exactly what I said. We were doing it live on the Zoom call. And these dynamics are very predictive of what they do. So the overnight, let's just kind of draw them really quick. 48.86, 48.91. So 86 was here. 91 is there. Let me move the zoom, I'll show you. So these are really good at what they do also. See, the overnight pivots are great. MHP 61, way down here. And market just opened and kept going. Oops. Here, market open. And on the Zoom call, I was like, oh, it'd be nice. I'd love to buy the dip down in here to continue to rally. These nice little long up. These are trying to forecast what the morning's liquidity map is going to be at the overnight. That's how it's designed to do. So you have the hedge pressure possibilities are here. Here's your long L. Here's your up here and here, here and here. Y'all see how it's very similar in the overnight. So it's almost like you think, oh, it's like a bull long up probably overnight. So open, there's really no place to pivot from except for here, and at least in our overnight strategy, we don't really have a lot that we use. So here it's like, it's still bullish. So still have that upward boost right there, yeah. Anytime it gets close to them, especially you can see bull continuance. It's like, nice, it is continuous. We're going to dip and keep going. I like it. But we didn't dip, right? We moved and we just kept going this way. All right, PMI is coming out in, like 9 minutes, I believe. 7 minutes. Get ready for this. It's going to be some turbulence. If anything, remember, the market is so bullish. It's so bullish. It can't be any more bullish than it is. We talk about this. All the signs are bullish. DD ratio greater than half, bull market. SPY monthly map. Remember, you have all these cheat sheets available to you from our Discord. You need help with them. Discord link is in the description below. Go there. I'll show you how this works. Give you all access to this. The S&P monthly map's getting a little jumbled. Okay, it's starting to jumble up a little bit. It's still not bearish. It's still very liquid. Look at this. This is interesting to see. It's slightly down, which means we're still long in the market. The bear side is sloping slightly down a little bit, then up, then down, then up. So bears actually over a little bit of time is actually bears shorting more. Let me see this. So bulls are longing more, bears are exiting longs for a little bit. I mean, exiting shorts, but then shorting more. So they're almost pointing towards each other like a little V shape. So I would say that over the next week, bears are shorting more, bulls are longing more. This is very, very liquid market and non-volatile. There's no space between these, as you can see, and they were pinching together like we showed. So liquidity increasing, no volatility. And as you see, as our technology predicts, there is no volatility, and the VIX futures has just been collapsing. How cool is that? Monthly maps is faster than futures at seeing where things are going to do. Represents that state of non-volatility, completely collapsing. That's how you read this. So these are all available to you guys. Make sure you don't use your cheat sheets all the time. All right. So it's not bearish. I think bearish about the market. DD ratio 98%, which means 98% of the stocks in the S&P's market cap. Weighted number, 98% of the market cap in the S&P is in a bull zone. So all the stocks are also trading in bull zones. That positive delta pressure from hedging. Long delta. There we go. That's our setup today. Wish I could show it not drawing this in like a purpley color. That's okay. All right, and remember, Nasdaq has already tapped DD band. When you tap the DD band, typically your day is over. There's that alert, yellow. If I were to trade anything from here, I'm going to trade at half pressure, right? Half size. Red light means I don't trade at all, or trade 10 or 20% of what I normally do, something very tiny. Any yellow lights means I caution my trade. Something's already happened, so it's going to likely be the majority of that awesome move has happened. So if I trade anything, I'll just maybe half position. Easy as that. Now we're going to wait for the news to come out. I'm going to take a guess that the news might do this. And then the market's just probably going to try to respond. It's looking for any reason to sell. A move like this and a pop typically turns to a drop. But I'm not going to trade it like that. So what I'm probably going to do is when the news comes out, if it moves, I'm going to sit out and just let it do its thing. Wait. Set an alarm. If it get close to hedge pressure, I might scalp from here to here, as long as the resilience is healthy enough. And they're looking okay. They're trying to sell off, but they're still pretty good. No irrational market. Resilience is greater than 0. How to read all of our tools. So things are looking still strong and healthy. Our resilience shows you how you flex through the redistribution zone on the indices. So let's look at QQQ really quick. They're both positive and positive. So it means that the half gap, all those other things are going to be pretty decent support. So inside of the redistribution zone, this box right here is one of our best tools. This is my favorite tool, actually, I use. Here, inside of this box, the flux is this way as long as this resilience number is 0. It's going to want to kiss that open, and which is this open, blue open on liquidity map, also matches with the resilience being positive. That's why I always make sure I mention it here. QQQ is too damn high. It is, I know, way too high. So again, I'm going to draw in a color that's not dark, the darkest purple I can find. Sorry about that. Let me redraw it again. DD 1A open, blue, open, 1B. Easy as that. Keep an eye on those numbers there. All right, now we wait 3 minutes. So because it's really close to the high of the session that I'm looking for, we always consider the DD bands like the high of the session, right? Beyond them, it's random. Sometimes you can break and keep going. Sometimes you can hit and resist. Be very cautious here. I want it to go lower if I were too long to there. A nice little dip on a news event to at least scalp from here to here would be a decent trade. So let me go ahead and get ready to fire off a quickie scalp. I'm gonna go here. But I think what I'd like to see today is a trade from here to there and then let it be random and then figure out what the day's going to do at the second half of the day. Yeah, for like better R&R, I'm looking for like, well, not even just negative res, but just a dip from here on positive res. If it starts to fall through here and resilience is negative at any point, I can trade it down through here. But in all honesty, it's still positive enough. So there's not really a good case for a short just yet. I hate trying to short a bull market betting on it falling apart. So what you're doing is, if there's negative res, yes, there would be a better R&R. You were correct. So the question is, will there be negative res? Yeah. Usually to half gap. In the days where the market's like selling off in a bull zone, I like to just, especially when you have some cautions, I like to just take the scalp inside of there. If res is positive, I can scalp from here to here, close out some, and then hold a runner to there. But in those days where a catalyst creates a sell-off in a bullish environment, typically that bullishness is strong enough to get you at least a half gap. And I could sell out. So a lot of times I'm not even greedy. So I tell myself, about 3 or 4 days of run, if the news happens and does this, right? The news comes out, pop, and then drop. I would love to scalp the half gap, wherever it is, and just take that leg and make my one trade that. Let's see what we got. You can do both though, but Lee, yeah, the second time I would close the majority out here and then maybe hold a runner there. So a lot of times I'll just scalp the half gap and call it because I know it's a quickie. Let's see what the news looks like. We did have that read come out. What are we talking about here? Okay, so this is the services PMI. Friends, don't forget to hit that thumbs up button below. Give it some love on the algorithm. Go below the screen, please. If you can do that for me. I love you so much. So it's a survey of 400 executives in the private sector. It's everything from transport, communication, financial intermediaries, business, personal services, community IT, hotels, and restaurants. And so what they do, they survey a bunch of people, and the questions are like a yes, no question. Is it better or worse? Almost like going to the eye doctor. How is this working? How's that working? Is it better? Is it worse? Is it better? Is it worse? Better is worse? And they fill out a little survey. And if it's better, you'll be above 50. If they think it's worse, it's less than 50. So anything below 50, you would consider contraction in the services sector. Anything above 50 would be expansion in the services sector. So the fact that we come in at 51 is great. And the fact that we come in across the forecast, 51.4 on top of 51 is a beat. So that's pretty decent. Again, it's surveying a bunch of people that work in a bunch of companies. Like, what do you feel like the state of your business is in? It's a very subjective thing. They may have metrics they report. They may just use their opinions. That's the services PMI right here. That's the global composite purchasing managers PMI. Similar, slightly above 50, we're good. Might have that open 3 different times. Oh, the composite. And that's a 52 right there. So they're all decent. They're all doing well. They all came out pretty strong. Okay. But the thing is that the news is always random. And that's one thing that you learn, I guess, the more you trade here, from my opinions. The news is never going to matter. That's one thing as a trader. What comes out on that report, you always have to ignore. It's never going to matter. It's almost always effectively priced in. Like the market already knows what the answer is going to be. Because the quantitative forces in any firm these days are really strong. They have such strong algorithms, such strong metrics that they can track all the pieces that go into that and make a really solid estimate. They're usually really good at guessing. So the fact that it dropped and returned to the normal place that it was before the event means it's a non-event. So this is a good example of what's called a let's go here, a non-event. So the market is always moving to guess where every event is going to be. Let's give you guys, here's a lesson. We always have these fun lessons every day. So this is not tradable today. Resilience is trying to go negative. Be very cautious here. Watch these numbers. These numbers are looking pretty bad. It's trying to sell, so be very careful. I'm not going to short it, but it is trying to sell. Resilience is trying to go negative. My call today is that we're trading lower. So I'm not going to short it because I don't ever short the greater bull market. I just know it's going to be likely dog shit. So I'll watch it fall and be a fucking expert and pro on the sidelines. Why not short if I think it's falling? I like to have maneuverability. I like to sit back and just feel like I have control and power. Anybody here, type in chat. Have you made a trade? Are you long? Are you cautiously sitting out? Are you shorting? What are you doing? Let's hear your ideas. I like to be empowered. Okay, so I'm going to wait for a long opportunity that presents itself, but I'm going to go ahead and let this market pull back just a little tiny bit. I like to short when it's bear markets. Don't get me wrong. You know me, Matt only shorts off of monthly hedge pressure from below monthly hedge pressure, or sometimes off of hedge pressure from below hedge pressure, and just against hedge pressure only. The only times I short, because shorting markets are different than longing markets, are the following. I like to short off of monthly from below. I like to short off of hedge from below. I like to take these shorts when it pops, and then I short, pops, and I short, pops, and I short. Shorting is different than longing. I like to be the first one in a short on a nice little pop in a bear market. If the market's pulling back in a bull market, it's a lot harder to trade. Why do you think I don't like to short bull markets? Let's see how smart you guys are. Scalping puts, no trades yet, sitting out, you short the hedge pressure. So why do I not like to short bull markets? Hello, RS, what's up? Tell me why. And tell me why I like to short bear markets. Example, bull market, right? Monthly map, bullish. DD, bullish. Greater than monthly hedge pressure, bullish gamma for the month. Why in these environments do I not short? And why in bear markets do I short? You got some stats. 5 is hitting one of them. There will be more green days and red days. Play the odds. That's correct. Tell me about the style of trading. Let's see if you guys can think 3 or 4 steps ahead and try to read my mind. Go deeper. There's a puzzle piece that I'm not mentioning. Resilience, not resilience, Adrian. Because in both cases, there are more green days and red days. You guys are correct. There's going to be more green days and red days. So in general, y'all are right. I don't short unless I have a really good reason to, because there's more green days and red. You guys watched that video. Yes. Think even further mechanically. And it goes with the lessons of the last couple of days. Why is it weird to short bull markets? Let's see if you can hit the right note. Dive deeper than what you're saying. The mechanic of how the market moves. All right, sign up for trial. How to get access to the Discord server? Go to the description below the video and go to the Discord server. Trend. I love that y'all are guessing. Think. Whoa. Hold on. Lee. Everybody pause. What the hell are you saying there, Lee? There's a word. There's words there. Volatility. Volatility. Rhymes with small ability. Okay, let's talk about volatility real quick. How does the market sell off in a bull market versus how does market sell off in a bear market? Imagine this. In a bull market, do you think that the market's doing this and I'm going to short it and all of a sudden it's going to do that? Or do I want a bear market that's going to pop really quick and drop really quick and then get out of my scalp and then let it do its thing? Bull markets are not volatile. And in the greater scheme of the SPX, volatile markets, sell-offs typically come with volatility. If you short in a bull market, it's going to be like an all-day thing and fight its way lower forever and ever and ever and ever. It's such a slow-ass trade because it's not volatile. You have no access message to the Discord server. You buy the platform. When you go to the server, if you have a membership or you subscribe to our platform's memberships, you automatically get access to Discord. So if you're just here viewing the stream, you have to join the Discord first. And then you'll probably just see like an ask for help channel. Ask for help. Say something here. So when you log into the website, like he's going to tell you, you'll connect your platform to Discord and we have a bot that's automatically going to give you access. So the Discord is open, but to get access to the channels, you have to have like one of the membership tiers, RS. Like Andrew's here. Hey, what up? Everybody say hey to Slacks, gracing us with his presence this morning. That's Mr. Slacks himself here in chat. Does everybody see how I love when I draw something and it's doing that exact something? Shorting a bull market is excruciatingly slow. Is why I don't like to do it. And chances are it tries its damnedest to recover itself. Do you guys like how when I love when I talk about something and I draw something? Exactly that. It's a fucking snooze fest. But also probabilistically, there are more green candles than red candles on daily chart in all markets. Remember the video? We did the candle count. We went counted all the candles in the entire sell-off market. Y'all want to play candle count today? That's such a fun game. Let's do candle count in a second. This is always a fan favorite. Don't go anywhere. I'm about to blow your minds. But yeah, but the bull markets are not volatile. This is that. Let me tell you guys, like, go a couple extra steps. Bull markets are not volatile. So it's not going to have a lack of buyers to buffer any selling pressure. it's going to take forever to ultimately work its way lower. And then maybe it'll capsize for a hot moment and then be done. And I would get out of the trade. You see how it's like excruciatingly slow and it's not finding any selling is buffered by immediate buying because the market is completely liquid. Bull markets are very liquid usually because you have dealers shorting to longs. Markets are liquid enough. Liquid markets do not crash. So when you're shorting a liquid market, it's terribly slow to the downside and it's terribly smooth and clean to the upside. It's the way markets move. And this is professional trading 101s. Okay. Does everybody understand that? It's the way markets move. Liquid markets have really excruciatingly slow downside all day long. And bull side is nice and clean. It moves. It doesn't pull back. Moves and pull back and moves. Illiquid market or volatile market, when they have bear setups, the market tends to move very rapidly, collect some liquidity, and then move again. They look completely different. These are the days I like to short. I like to short off of a hedge pressure pop to some level and get out really quick before it retraces. So understanding the two types of markets you'll have and how you trade them is a little bit different. Even though things look bad, why am I not shorting a bull market? Because it's not volatile. And that was the answer I was looking for. Alexander nailed it. A lot of you guys nailed it. Leonidas, nice job, nailed it. Y'all pay attention here, and this is what I love about you guys. Y'all pay attention. Even though the signs don't look good, and it's a bull market, I tell myself, well, bull markets tend to recover themselves pretty easily. The signs don't look good, so therefore, I'm just going to be a not bull today and sit out. Am I going to try to short it like it's going to crash? Not really. Can it possibly crash today? Well, all the signs are there. Am I going to bet that it does? Adrian, next level. VIX is above the triple B and VIX is in a place where it can sell off faster. The answer is that's a higher probability of shorting in a bull market. You have a less liquid market with VIX hedging itself higher, which means the options market can spread out a little further and then create more turbulence. So let's take it one step further. In a liquid market, let's just do below triple B, razor sharp pivots, right? If we were above triple B, like you said, right, you're going to expect it to have a little bit more volatility. So it's still going to be excruciatingly slow in a bull market, but it's going to have a little bit more like move to it. Instead of just like a tight, choppy, it'll have a little bit more downside. And then of course, in the same sense, in a bear market, it's just going to be like, it's going to be very smooth and clean to the downside. It's just going to collapse. So greater than triple B, bear. Let's see. This is the bear market side, bear. This is bull. Markets move differently in different environments, and you have to know all of them to trade them well. I love when you guys come here. That's what we try to teach every single day. Cool, cool. All right. So volatile bear markets are going to be volatile, and you're going to have a lot more selling pressure. Less than triple B, you have more periods of liquidity. Like it's going to fall, retrace, fall, retrace. This is going to be like it's going to fall and just stay there. Any quick pop is going to immediately get sold off. It's not going to have periods of relaxation as much. So this is like crash scenario. Greater than triple B versus less than triple B, you're going to have a little bit more potential for volatility. It's going to start to accelerate faster. And this is going to just start to drop excruciatingly. So let's play candle count. Y'all like how we just show you different things? If you didn't know this and you're like an index trader or any kind of trader to begin with, knowing how markets move is our specialty, guys. That's why we exist here. I'm going to give you tools to show you this. See how it's just so slow. I like to get in and get out very quickly and walk away. Not that nobody is selling. I would say that when markets are liquid, it means buyers and sellers are all in the same vicinity. They all agree on price. I think like liquidity is like, think of it like everyone agrees on price. The more liquid a market is, you'll have either more traders in general, or more traders around the current price in general, ready to trade, agreeing on price. So traders, buyers and sellers are all here. So the market will buffer selling pretty easily because there's buyers nearby. Let's play candle cap. So you watch. Let me go back to here. All right, so no longing for me today. Resilience was giving a heads up that things are going to turn bad. We saw that earlier. Love that resilience number. Let's play a game called Candle Count, right? Let's play this. I love this. Ready? Let's play a game. Ooh, why did it do that? No, that's not what I want either. Blink. There we go. Oh, I was like, what's... Oh, I know why it's doing that. Hold on. I was like, that still has that's the future step. Okay, I was like, why is it DD bands on? All right, let's make a clean supply chart here. Candle count's a fun game. There's all of this. This is the blank chart. I don't know what all this is from, but let me go ahead and remove this. I'm going to play a game. Everybody pay attention. Don't miss out on this one. This one's pretty exciting. All right. So we'll click the candle count game. Okay, ready? We're going to see how many... This is one of the reasons why it takes a lot for me to want to short a market. I need a very good case to short a market. Okay. And I know it's coming down. I'd rather just sit out. Odds are always against me. Let's just pick any run. Okay, let's just pick any bull run. How about this one? And we're going to count the candles, okay? We'll count the green ones from bottom to top and the red ones. Okay, ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 14, 15. Hold on, 4, 5, 6, 7, 8, 11, 12, 13, 14, 15. Yeah, 15 green and reds. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. Pretty decent ratio in a bull run. So when the run is up over the course of what you're counting, bull run, pretty solid green to red ratio, right? Let's pick a bigger. That's just kind of an icebreaker. Let's even zoom out further. Let's pick like longer bull runs, right? Let's pick like this bull run right here, from bottom to top. I'll show you guys one more thing here. Ready? Let's go from here to there. 1, 2, 3, 4, 5, 6, 7, 8, 1, 2, 4, 5, 6, 7, 8, 9, 3. I just 31, 3, 4, 5, 6, 7, 8, 9, 4, 1, 6, 7, 8, 9, 5, 1, 2, 3, 4, 5. 55 green. Okay, this isn't a bull market, right? Bull market. 55 green. Reds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 20. 1, 4, 5, 6, 7, 8, 9, 30. 2, 3, 4, 5, 6, 7, 8, 9, 40. You can see there's a really healthy ratio of green to red candles. You'll see this. So in any bull run, there's always a very healthy ratio of green to red candles. Like the day ends up green no matter what. Sell-off days quickly get squashed, and the ratio is clearly greater than 1 to 1. So typically, I mean, you can do this for any run, and you'll typically see that a bull market is roughly between 50% and 60% green candles. It's the case. The odds are in your favor to be green. It's like that slight edge you have in the casino, or the casino has with the 00 and the roulette wheel, right? Slight edge. You've got slight edge just throwing your money stupidly long at the market. Thinking like that at all times. Does everybody see this? Pop quiz question. Everybody see this? If you were to use risk management and just stupidly with your eyes closed, throw your money at the bull side of the market, 60%, 50, 60% of the time, your money will go up, right? Just in general. So shorting against those staggering odds, like anything greater than 50%, like 50.1 or 50.2% is an edge. 50 to 60%, 55 green for every 40 red, and you can count any period. It's typically this much. And again, this is empirical, but it just shows you that there's more edge longing the market than shorting the market. And the meme stonks always go up comes from this. Markets, index funds always go up. Right. Calling Warren Buffett stupid. He's genius. He just plays the odds, right? So a bull market does this, but let's talk about a bear market, right? Well, Mr. Streamer guy, you're just talking about bull market. What does the bear market look like? Let's pick a run of bearishness. How about we pick that? Let's pick the obvious one, right? Let's pick this. Let's just look at a smaller one first. Let's look at a bear run. Okay, from top to bottom. Okay, ready? This is a smaller one. We'll do the smaller one and a big one. So from high to low before the market distinctively pivoted. Ready? Bear market. So when you trade, it's always about odds. It's like playing poker. Let's count the greens. Let's count the reds first. Ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 3, 1. Let's count the greens. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 4, 5, 6, 7, 8, 9, 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 3. 1, 2, 3, 4, 5. 35 green. 35 green? It's bear market. Huh? What? The fuck? Wait, what? Shit's supposed to crash in red days after red days after there's more green days and red days in a bear market? No, that can't be. There's more green days than red days. This is a small data set, Mr. Streamer Guy. Do that again. I want to see this again. Pick a longer period. How about the biggest bearish sell-off market thing that we had in the last couple, decade or last decade? Our 1 year sell-off that we had. Okay, let's do a bigger data set. How are there more green candles and red candles in a bear market? That don't make no sense. Let's check out this one. Okay, ready? It's got to be different. Got to be different. Count the reds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 3, 4, 5, 6, 7, 8, 9, 20. 1, 2, 3, 4, 5, 6, 7, 8, 9, 30. 1, 2, 3, 4, 5, 6, 7, 8, 9, 4. 1, 2, 3, 4, 5, 6, 7, 8, 9, 5. I write this down because I'm old and I forget where my place is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 6. 3, 4, 5, 6, 7, 8, 9, 7. 2, 3, 4, 5, 6, 7, 8, 9, 8. 2, 3, 4, 5, 6, 7, 8, 9, 9. 1, 2, 3, 4, 94. Okay. This is now, mind you, like almost a year of selling. 94 red. Clearly, there's got to be fewer green candles, right? Well, let's go, shall we? 1, 2, 3, 4, 5, 6, 7, 8, 9. Wait, hold on. 4, 5, 6, 7, 9, 10. 1, 2, 6, 7, 8, 9, 20. 1, 2, 5, 6, 7, 8, 9, 30. 1, 2, 3, 4, 6, 7, 8, 9, 40. 1, 2, 3, 4, 5, 6, 7, 8, 9, 50. 1, 2, 3, 4, 5, 6, 8, 9, 60. 2, 3, 4, 5, 6, 7, 8, 9, 70. 1, 2, 3, 4, 5, 6, 7, 8, 9, 80. 1, 2, 3, 4, 5, 6, 7, 8, 9, 90. 1, 2, 3, 4, 6, 7, 8, 9, 100. 101, 102. Green days. And 94 red in a bear market. You see a pattern here? Doesn't matter what kind of market it is today. Traders love to buy this shit. It doesn't matter what period you pick. Long runs, short runs, you're always going to see a bias to there being more green days and red days in a market. It's crazy. It's about 50-50 as a trader. You want some stats to go with it. You roughly say that it's around 50% green and red in the worst kind of markets. Staggeringly crazy to notice this, right? I noticed this a long time ago. It's one of my favorite things to teach. What it means is that markets don't like to sell off. It takes a lot for them to. Even in the most bearish of markets, the idea that the market's going to collapse is very rare. You might get 2 or 3 days where markets crash out, inside of a bear run, like tiny little windows like this. But if in reality, despite those like 3 or 4 days where it's like short, and you're like, I'm going to make all this money shorting. It's not like a bull market where every day is like up, right? You get big swings, but they'll retrace and be volatile. This is V's we're talking about. Because bear markets are volatile, they tend to zigzag a lot more, which tends to create the effect of green days in the middle of the red selling. Volatility creates that. So the neatest thing about this lesson is that the odds are against you shorting a market at all times. Hey, look at this, right? How about that? So like I said, despite good news, good readings, whatever, the odds are always against you shorting a market. You need a really strong case, which means all things need to line up to stay short. Notice how, like, the market just, when I said it's going to excruciatingly die if it's going to die, you see how this happened and how many traders see this and go, ooh, that's the one. That's the one. I've been upside down for the last week, but this is the guy. I'm going to short this. Oh my God, wait, I'm upside down. What's going on? Huh? I'm losing money. Like, somebody's been, you know, short and losing and short and losing and short and losing. And all of a sudden they see this and they go, oh yeah, that's my end. I'm finally right. Market's going to crash. And all of a sudden they're here again. Don't short bull markets, guys. It's the stupidest thing you can do. Right? How come res is negative NQ is running? Because the index, here, let me show you. It doesn't mean, okay, let's start at the top. The S&P resilience calls the shots more than the NASDAQ resilience. Again, we've already broken through DD bands. You can answer your own question. When these lights are red, you don't use this anymore. This is no longer applicable. You throw these out. You know better than that. Come on. We don't use resilience. We don't use the DD rules. None of that when markets are irrational. Red line means to turn everything off. Yeah, you throw it out. You throw out all your technicals. Once those lights turn red, your technicals aren't going to be any good. No technicals are good. The market is broken structure, so you throw it out. The conditions of our strategy require those lights to be green and yellow. And you throw out res. Questions, you guys? Throw it out. Questions? The reason why they'll detach is because the S&P and NASDAQ, they trade on their own. And what this is telling you is that the stocks are trading lower. And the index is trading higher relative. They can detach. They trade independently. But most of the time they don't. In rational markets, when these are green and yellow, they tend to stay tethered. So the idea they're detaching is pretty common in irrational markets, which is why whenever you're here, you throw this out. Anybody have a question about that? They can detach. The probability of that's really high. That's what the red light tells you. Red light is irrational. So what normally happens, the index following the stocks is a rationalization. And irrational markets just going to do random things, right? People are getting margin calls on one or the other. Market they can diverge from each other. Yeah, as Faust is saying, smaller size plays, cautious plays, no trade at all. Exactly, 100%. Does that make sense, everybody? Let me know. So now one may ask, would it be a strategy after every X red days go long? One could argue that after 3 red days in a row, it's a good time to go long, 2 or 3 red days. The thing is that where you go long at and knowing that the market's going to be volatile. So it's hard to trade that knowledge. Let's keep that in mind. Because like, imagine this red day, red day, red day that turns green. Then red day, then red day that turns green, then red day. It tends to do this. So one could say, yes, you can catch those green waves, but the problem is they typically pattern with volatility to go with it. It's harder to know where you're going to long from here, and typically you'll hit stop losses before it turns around. So if you were investing in the market, if you did what I like to call the 401k strategy, is at the end of every red day, just buy some stock. At the end of every red day, buy a little bit more. At the end of every red day, buy a little bit more. And then at some point, they'll all be in the money. You longed here and longed here and longed here, then there you go. You're now making money on that trade. Close out on the next green day. Buy some stock, close out at the end on the next green day. So you're just throwing money at lows stupidly, like your 401k just throws money as markets dip. Mutual funds just buy the dip, buy the dip, buy the dip. As markets dip, people continue along. But day trading, it's very hard. So let's take the opposite case. Not if there's more green days than red, should I long every red day? At the end of the day, like if I had $1 million, at the end of the day, I'd buy like 10, 20K of stock. And the next day buy 20K more. Next day buy 20K more. Not risking a lot. Then making a little cash, closing out the first green day. Now, again, not a good strategy on application. Like where do you long from and stuff? It's really hard. So beginning of the day and end of the day, like most major funds do. Now let's take the other side of the coin. If you know that most days are going to end up green, then don't short into red. Oh, it's a sell-off day. Let me catch some of this red. Because ultimately, the majority of those days will flip green despite selling at the initial part of the day. Does that make sense? Mike, do not skip our risk management study in here. This is what I love about people coming here. Those of you that have learned trading or learned trading elsewhere, you are now staying and standing in a very good place. This is the best trading education you'll ever get in the entire planet. Trust me, take it from me. I want to teach you guys something that nobody has taught you yet. This is guaranteed to blow your minds. Get ready? Hold on one second. But anyways, taking that knowledge further is knowing that most days are going to end up green. I don't try to short into red. So the trick is no shorting ever into red. Instead, once all the things line up to be bearish monthly map, below monthly hedge pressure, bearish DD, I wait for those days to just retrace on volatility and hit hedge pressure, and then I immediately short off of it, and that's it. So because the candle count ultimately, like more than half of the red days turn around and end up green, instead of longing it, I just know, aha, like I'm just waiting. Oh, there's that green day. Perfect. Okay. Now let's wait till the next day. Oh, we're trading here and there's hedge pressure up here. Perfect. Let me short and then short off a hedge pressure really hard to get the sell up. So in bear markets, I'll wait and short the pop. In bull markets, I never short against the bull market. Okay, Mike, ready? Best trading education you have. At some point, someone told you a book or an indicator or a YouTube channel or something that told you put a bunch of squiggly lines on your chart. A bunch of patterns. Let's draw some terrible things. The bow tie pattern. This is the vertical lines pattern. Let's draw some dots, draw some X's. Most of your charts look like this, right? Everybody. And they're constantly like throwing signals at you. Buy, sell, buy, sell, buy, sell, buy, sell, right? And so what you realize is that the reason why you guys have never made money using technical trading systems in your entire life, and neither do the people that sell them, is they lack one particular thing. Let's see if everybody knows the word. I always use a specific word to go with this. They lack one particular thing that's required for any kind of system that's betting on odds. You require one thing. There's nothing works 100% of the time. You can't create a strategy that exists in the spectrum of all price and time, okay? Your strategy works in all cases, 100% of the time. Signals at all times. This thing is, this dashed dotted colorful line on my chart is going to predict everything at all times. Discipline, consistency, risk management. You guys are close enough. Risk management. The word I use is conditions. To buy, so your risk management strategy, they lack a risk management strategy, correct? The risk management strategy is conditions. This is the one thing you guys are going to learn, is that anybody that proposes something to you like, hey, this is what I use to look at the market, you must first ask yourself, now, to be honest, have you ever bought some, everybody here, help me out. We'll take a poll here because I love polling the group. Have you ever bought an indicator from a marketplace or something and just threw it on and started playing with it? Have you ever, when you did that, asked the person that made it or read, what are the conditions that this indicator works underneath? Have you ever asked yourself that? And I'm going to train you to do this every time. What are the conditions? Because we don't say that ours works all the time. We don't even say that it works. We don't make any kind of claims at all, but we apply it in certain areas of the market where it works better than others. And we ignore the rest. The trading strategy is a very specific application. And what are the conditions? Well, you'll learn this, Mike, and everyone else. Pay attention. You're asking basic questions. Who's here? Pay attention. Everybody. Conditions. They're here. We train you on these. They're in all the videos. If any one of these lights are red, you're here. You're outside of the boundaries of where we apply our strategy. Any red, this is zero. Just consider these all being zeros floating around out here. So the conditions are that when these lights are all yellow and green, then we're good. When any of these lights are red, you throw your indicator out the window. You turn it off. They don't apply. Does that make sense, everybody? Conditions. The conditions are rational market, which is green or yellow, and non-random, which would be like the other random rules, like less than 2 p.m., etc. So our conditions are as follows. From 9:30 until 2 p.m., we use the indicators. After 2 p.m., the last 2 hours of the day, this light turns red and you turn them off. So we have a time window that we apply them in a window of other conditions that show the market's broken or doing something different. So green and yellow. When the light is red, sometimes some people will trade, but red light also means 20% of your position. Green light means that you can trade 100% of what you normally will trade. That's not 100% of your account. What it means is if you normally trade $1,000 on any position, then 100% is you go your normal position. Yellow is you trade, there's 3 L's in the word yellow apparently, 50%. And red is 0 to 20. So most people in red choose to sit out, which is what I do. Some people throw pennies to dollars on that and say, oh, it's red. Okay. I still want to gamble. I normally put $1,000 into every trade. Let me just do like $200, something small. So not only does this tell you to throw the indicators out and turn them off, which is your risk management plan. Part of that is the conditions on when you apply your strategy. The other part is how much do you bet? If I were to even make a trade, it would be 20% of normal. Therefore, if I try to chase a short and I was wrong, well, I didn't get squeezed out too heavily. I'm not full porting this today. Does this make sense, everybody? Big fat yes in chat if you follow. Any trading strategy must have a place where the edge is. If you buy something from some weird shirtless guy with a mullet. He's yelling and screaming, "Buy my indicators." I'm from Texas. I can make fun of a southern accent. He's the reason it's called a toothbrush instead of a teeth brush. And he goes, "Buy it." Signals all the time. All the time, every time. Signals. Works. Buy, sell, buy, sell, buy, sell. And there's no anything inside of that system that says, you know what? Turn these off until something gets better. If there are no conditions applied, then it's garbage. It's literally garbage. There's no such thing. Number one, is no such thing as a strategy that works in all environments. The stock market is such a large, dynamic thing with so many moving pieces. A really good strategy will isolate a set of conditions that it's very strong in, and then you develop a risk management plan inside of those boundaries. That is stupid. And stupidity is a big industry because people have no idea that it's stupid. It looks cool when they stare at it. It looks complex. It looks technical. Oh, wow, this looks really good. But in reality, as any mathematician or any poker player will tell you, when you're betting on a game with odds that you can easily calculate, as long as there's a fixed number of cards and you know what they are from the start, you can always calculate your odds if you track what's been played and what hasn't. There's always some odds. But see, there's no fixed deck of cards here. It's completely open-ended. The stock market can go to infinity or to zero. Hell, the futures market can even go negative. We've seen that happen before. We've seen oil go to negative $50 one time, April 3 years back. Okay, but think about it like this. Because it's so open-ended, you can't at all bound the stock market with some kind of strategy that works 100% of the time at all times, every time. Just silly. You have to exploit some piece of this giant machine that has millions of pieces. You have to find one little piece and then draw your strategy around a couple of pieces that you like, and then just kind of leave the rest out. So your strategy is going to work under very specific conditions and work better under those conditions or be more applicable. And then you have your risk management plan inside of that, which your strategy is supposed to give you more wins than losses as your goal. And the risk management plan is supposed to control how much you lose when you do lose inevitably in that strategy. That doesn't work 100% of the time. Do I have a stat for how often the market becomes irrational omitting 2 p.m. condition? I don't. And we could, when there's a back test, you can create a number that would say this particular environment, market becomes irrational X% of the time. You could very well do that over time, but we don't have a backtesting module yet to be able to do so. To predict that the market would become unstable, it would be an impossible thing. I would always, in my papers and things I say papers, my writings on this, the going theory is that the answer is you can't predict irrational market, because what makes them go irrational is somebody's ability to hold on to a position. Example, imagine a fund has $1,000. I'm just gonna pretend this. I wrote the word billion, but I'm only writing a bunch of. I'm only writing the word thousand. Pretend this is a billion. And they're all in, right? And all of a sudden, the stock market starts crashing. Irrational market would be that they get a margin call and they're forced to sell, which forces someone else to sell, and a margin call forces someone else to sell. Here's the problem. You as a trader, you are asking yourself, what's the probability that this firm is in a margin call here? Which can start a chain reaction to kick other firms out. And you're trying to create a strategy to guess what's the probability that the market becomes irrational? Because that's basically what you're saying. What's the probability that the major fund on Wall Street's in a margin call? And they're going to, even though resilience is positive, they're in a margin call and they're going to get squeezed despite positive resilience, which makes the market detach from the indicator. Do you have a way to know their exposure and their ability to raise money? That's the best question, Bikram. So in my theories, of what we've created, the answer is it'd be hard to. Now you can create an empirical number that states the overall probability, but what's the probability that this particular day creates the squeeze and not another day? So the hardest part of that is understanding is that the exposure of this firm is behind closed doors, right? No indicator anybody can create would be able to tell you that these guys are in a margin call. And number two is, in the margin call, they even have options. Number one is they can sell the stock. Number two is they can just throw more money into the pot. So you'd have to have an indicator that knows A, their exposure, and B, how much cash they got on the side from their partners or from anywhere else to throw in to maintain the margin call. So half the time they might even choose to throw more money at it and buy the dip further. So to predict irrational markets would be claiming we'd have transparency beyond the veil of what firms are doing. We don't, right? And so I consider it a fruitless effort to try to create something to predict irrationality. And then when you think about it, it doesn't make sense on the surface when you say, can you predict irrational markets? And the answer is maybe you could come up with a stat that might help you with your trading decision. But do you really want to try to create something that predicts irrational market? That'd be like saying, can you predict which person in a crowd is the serial killer? Just by looking at them. You might have some telltale signs. Oh, that guy's covered in blood. No, he's probably him. Or that person has a weird look in their eyes. He looks scary. Maybe him. Or that person is looking at me weird. It's probably her. Right? But are you right? And the serial killer could be who you least expected. And it usually is if you watch crime dramas. So the answer is to try to predict which person is behaving irrationally. You'd have to dive into their head and really read what their mind is doing. And it's hard to tell on the surface if people have the ability to be in trouble or not in a margin call. So while you can create an overall stat, my theory would be that the stat would be very hard to isolate inside of like, these are the conditions where irrationality is easy to predict. Now, again, you can draw a very clear line that in a bull market, in a bear market, it's likely that in a bull market and bear market, there's probably more rational days in a bull market than bear. I would say that if I were to choose, you put a gun to my head, said, pick which one of these will have more rational days. It's clear that a bull market might, so that you could derive a slight edge from that. We'd have to define what a bull market is, which we do. All right, monthly maps are converging, or monthly maps are both pointing down. You're greater than MHP, and you have DD greater than half. So this is what we call our greater bull market. So in the light of this, you'll probably have more rational days than this. So we could create a probability off of that. In general, I would say Bikram, yes. Under the greater market conditions, what I call these three indicators, you probably have more rational days than not, but you'd have more cleaner, easier trading days. So irrational would be like, how can I predict today I can't trust resilience because of some conditions? And that would be harder to do, I would say. We could create a stat and call it like a confidence indicator, like how confident are you that these things are still going to apply for the remainder of the day? And if I were to pick one thing that's going to lead to, if I were to pick one thing that matters more than anything else to create a stat on, I think the answer would lie in volatility. If we were to create an indicator that says, what is the stat or the probability of irrational days versus rational, and we were to create conditions for that indicator. So we would need conditions, right? And let's say that what kind of thing would be present that would lead a market that's easily planned into, oh crap, that happened and we didn't even know. Oh God, we're getting a margin call. They got a margin call. So are we. Crap, we got to sell. What's the highest probability of a chain reaction? Number one, we'd have to have something it be volatility based, right? Because volatility is that indication that there's lack of buyers. And if the market's selling rapidly because of a margin call, the probability of chain reaction is very high, right? Chain reaction probability goes up. So we'd have to have a lot of our conditions based on volatility. So maybe in our stats above triple B, VIX is bounced, things like that, could be a higher probability of irrationality. Does that make sense? Everybody? Keeps going higher and higher and higher. Yeah, that's what I said. They don't give you guys trading advice to start a day, but we don't short bull markets here. Does CD band account for volatility? Aha, right? We're on to something. So greater than triple B would be one of the conditions. UVXY bounce rule. Greater than DD. Yeah, all of these things. Well, greater than DD actually would already be irrational. So let's start that over. That's redundant because that is by definition already irrational. So we're trying to create a prediction of irrationality itself. So we can't use DD as one of those measuring points, right? What you're asking, Vikram, is we're trying to predict what's the probability DD band will break versus bounce. That's a great question people have already asked. What's the probability that bounces versus breaks? So it's the same thing you're asking. What's the probability that we are irrational versus rational? So you'd have to look at things that aren't irrational conditions. Like the higher the volatility or the higher chance of increasing volatility, the higher probability that you have fewer buyers on a dip. So let's say low volatility versus high volatility. Fewer buyers, so chances are it could sell off further. Chances are it can try to sell and hold. So the higher the volatility, the higher the probability of cascading margin calls because there's lack of buyers. So it's a domino effect. So all stats of possibility of irrationality likely exist in a realm of some kind of measures of volatility. Because everyone else that's planning and trading probably has a really good insight or feel of the market. And so to surprise a hedge fund or somebody and force them into a margin call, either A, they're very, very, very poor planning, or B, they get surprised because somebody bumped into them and they're bumping into someone else into chain reaction. The volatility can create that chain reaction, the surprise everybody and catch them off guard. So my thoughts always were, if we were ever to try to create a probability of irrational versus rational days, we probably have to have a set of conditions, a separate set of conditions that are a bunch of volatility reads that look at different probabilities of like volatility. Does that make sense? So the answer is in volatile markets, it's probably more likely you become irrational than not. So like right now, what's the probability we hit DD band and turn around and hit DD band, keep going? We need to create something that can do that. And again, would that number even be useful? I would say on the bear side, like if the market's falling to lower DD band and you have all your volatility check, I wouldn't bet that it bounces and turns green. But it's like I said, it's random what everyone does in response to the selling. You don't know if people can survive it or not. So it'd be hard to apply it, and that's why we never created it. Okay, so here we go, right? Lesson number one, when these lights are red, the index is moving faster than the stock sometimes because it's trading on its own. The index is still squeezing, just like we showed you earlier. If you tried to short this, you know, I was stomping my foot this morning and saying we don't short. I literally talked for an hour why I don't short bull markets. Now you understand why. 49.33. Oh yeah, let's kind of look at that really quick. Pretty good lesson today, everybody. Hopefully so. You'll learn something today. Hopefully I'll learn something today. But as Bikram, I would say it's a great question. I'd like to try to pursue some kind of measure of volatility? Like, can we predict something, or sorry, possibility of irrational market? It would, in my theories, it would all revolve around your prediction of volatile markets becoming more volatile. So like, can you predict the volatility of the VIX itself? Things like that. That there's a snowball that you just pull the rug out from multiple people and force them into multiple people. The idea that you can't predict if any one firm can survive a margin call is a set of hundreds of people in a condition of market crash. You can predict that some of them will be, which will bump into others and bump into others, like a nuclear chain reaction, right? So I would say that the answer to any question like that would lie in, can we predict volatility? Because then you can easily make the argument that a less volatile market is less likely to have margin calls because you have more buyers to buffer a selling wave. In a volatile market, the buyers aren't there. So it's a higher probability that chain reaction happens. So where do you draw the line of, like, between the two? Where's that line in the sand where we're absolutely certain that this day is going to be irrational? And that would be hard to do, but we could create a metric, like a probability that, ooh, you know, we could call this irrational probabilities, and then have a couple extra measures that we do. And of course, when we have our back test, it'd be something we're chasing down. How good in a bear market, what's the probability that it holds and turns into that green candle? You know, what can we look at? My guess would be the answers lie in the VIX and the VVIX itself. So we need some tools to predict what's the probability that VIX decays and what's the probability that VIX accelerates. The days that VIX accelerates are clearly the days when you're likely to be very irrational. The days that VIX decays are days that big, yeah, maybe Vega and options. It would be a very correct. Yeah, it would go in that direction. 100%. Yes, sir. You're nailing it, right? So I think that it's not a terrible idea to use volatility. And he's saying Vega. So what Vega is a sensitivity of an option to the IV itself, right? So it would be something like sensitivity to volatility, which would cause volatility to compound on itself and create more volatility. You nailed it. So VVIX or Vega or things like that would definitely be part of the conditions. What's the probability the market falls apart? Well, things like that. So we could build like an aggregate off of all the Vegas of all the options or something to see, oh, probably the S&P falls apart because of, you know, a DD type indicator that's looking at the Vega of all the options, right? Of all the stocks in the index, or the Vega of the S&P itself, something like that. Or even just in general, using the VIX and the VVIX. What's the probability that, you know, the VVIX can go up, which is the volatility of the VIX itself. If the SPX is doing this, then volatility just went up. It's a step change in volatility. The V got bigger. If volatility got bigger, faster and faster and faster, the S&P will become exponentially wider, and there'll be some curvature to those peaks instead of it being linear. So the volatility index is going up. So the slope of the volatility index is a VVIX. So it's the derivative of this one. So the exponential, you know, like essentially when markets become exponentially more volatile, the VVIX is going up. VVIX, the volatility of the VIX itself, will cause those V's to become exponentially bigger. So can we predict, because that would be what would cause a lot of margin calls. So what can we predict in the VVIX? Right? Can we create some kind of metric to predict increasing volatility in the VIX itself? Things like that. And the answer would lie in options, I would say, Bikram. It'd be your telltale sign. And we would basically create a couple of red lights in here that say, oh, you know what? Probability of irrationality is high. So know that your trades are short-lived. If those lights are green, oh, probability of irrational market's still good. Like just a general stop and go. Yep. Your indicators are still good. Red, ooh, you know, your indicators might lose some steam here. Great session. Yeah, I'd like to create something that would, it's hard to predict that any particular day would fall apart based on its own trading of its own instrument. We'd have to look deeper and create a probability that, what's the probability that volatility is going to compound on itself? Therefore, the probability of high amounts of margin calls is high. Therefore, the probability of the first wave of selling creating a chain reaction is high. And that would be a great metric to have. As far as predicting straight irrationality, be completely hard on especially in a bull market when markets are liquid enough to handle any selling. So when I told you guys this morning, and we'll call it here because I'm not doing any trades. Remember when I said trying to short a bull market is excruciatingly slow? It's not volatile enough to create any kind of effect. We don't short bull markets for that very reason. Did anybody here, we're going to finish on this line, on this note. Did anybody here short this today? Or did y'all not short it? Right now, you hit DD band with a negative resilience. Take it with a grain of salt. Things are irrational. Nobody shorted this today. Y'all know better. We don't short bull markets. Somebody said, are you worried that the market's near all-time highs? And not worried. I don't care at all. I don't pay attention to any of that stuff. It does what it does. Yeah, I remember you did, bro. I know what you were doing. You probably shorted to here. You're smart enough to know that even in a bull market with stuff not looking so hot, you only short and take what you can get. Even in bear markets, same way. Once I get the quick move, I usually close out. If I'm confident it's volatile, I might take it to another layer and go. But I don't like bull markets all long and hold till the end of the day. Bear markets all short until I get that first red candle or two, then I close. I hold on shorts very quickly, or very little, and I close them very quickly as well. Yeah, no short, no short. Yeah, you guys notice, y'all know the same thing, right? Doesn't mean the market can't sell off today. This is very possible to see this for the day, but the idea is that I don't see that and take a short. You can rewind the stream and see we're smart enough to not fall for it. Yeah, and you know, missed out on the long entry. You know, I don't even tell yourself you missed out on the long entry. You just chose not to take it. Don't let your language affect your psychology. This is a great lesson too before I get out of here. You didn't miss out on anything. You chose to sit out, which is powerful. Tell yourself you were in control. I didn't touch this at all. Why? Because the market's my bitch. If I missed out, it controls me. I should have followed it and done what it did. No, I own this market. I chose to sit out, which means I chose to lose zero money. I chose to make nothing. I'm in control. And so are you. Love you guys. There's always a trade tomorrow. Correct. I love y'all. Language is important. Coaching yourself to be empowered is very important. We love y'all. We'll see y'all tomorrow. Zoom call at 4. So when you say like I missed out, it kind of gives you that, oh, I'm going to miss out FOMO mentality. I chose to sit out, baby. This market's my bitch. We'll see y'all later. I chose to lose nothing. I chose to not play this. I knew it was going to look weird. I knew it wasn't going to be easy to trade. I knew it was going to be kind of boring on the downside, maybe some upside. I knew that it wasn't going to be a nice, clean, easy trade. So I set out, and look at that. I was right. We're back to where we started, right at the open. How about them apples? Market went down, market went up, market's back to where it started, and so am I. We didn't lose any money, which is always good. Successful traders always know when to sit out. Zoom call it 4, baby. We'll do it. We'll love you. I'll see y'all later. Don't forget, go to the Discord if you have any questions. Feel free to check out the Rockscooter platform. All these tools can be yours. And we'll teach you how to use them. There's tons of videos to watch. And